All right, we are live.
Perfect. What's going on, everybody? Welcome to a brand new show. My name is Ryan Rozbiani. You're on the Benzinga Network. We're here with producer AB. Welcome to the brand new show called Benzinga Presents the Psychology of Trading. The purpose of this show, this is meant to be a way to give back to traders and help traders, new, intermediate, and advanced, with dealing with the different psychological aspects of trading that we all deal with on a day-to-day basis that not many people talk about. The point of the show is to keep it quick, keep it simple. Format is straightforward. First part, we will quickly overview what the market was last week and what we see it doing next week into the basic, straightforward index funds of SPY, QQQ, and of course Bitcoin. And then we will enter into the topic of the psychology of trading topic for this week. And then for the final portion, we will answer any questions we received via the Twitter about this topic or via the live chat. So if you have any questions that come about during this presentation and during this conversation, throw it into the YouTube live chat, and we'll definitely try our best to answer as many as we can. But the point of this show is to keep it short and sweet, and then we will optimize this for audio and put it out via a podcast. So I'm here with producer Aaron. Aaron, how you doing, brother? Producer AB.
I'm good, brother. How we doing? Just had
I'm
a
doing well.
had a nice weekend. Ready to get back into the grind tomorrow.
Me too, man. Me too, man. I'm really excited for this upcoming week. So let's start off with one of my favorites, SPY. So SPY has been having a very, very good week. We broke an all-time high almost every single day in the past week, and we hit a high of 411. Again, for folks who may or may not know, I'm using the Benzinga Pro tool here, one of the best tools out there for analyzing and viewing stocks. Again, we're just reviewing the market right now. So SPY hit a high. So what does that mean for me? That means that I'm getting ready to see a SPY pullback, not a big one like we saw sometime during the past month, but a very small one. So I imagine we will probably continue this uptrend just based off of previous RSIs of between 75 and 82 for when SPY makes its all-time highs and makes its bull runs. So I imagine we will get to somewhere between the 1013 to 1015 area, and then slowly have a small pullback or consolidation. So one thing that you can notice here, SPY, when it's been making its all-time highs, has just been consolidating. We haven't had much of a pullback. The only thing that bothers me is there's a gap between 400 and 403 on the chart right here. So again, gaps don't always get filled, but they could get filled. So I'm just getting ready for that. So if and when that happens, I'm mentally ready for that going into it. Again, psychology of trading. So we want to get you prepared psychologically. So that's SPY. Then
Well,
we're
that's
going to go
something
into
I
sure.
wanted to ask you about as far as for people that might be newer right now, and we're talking about the psychology of trading. So what about some people might be a little timid to get into SPY? They're like, oh, it's at all-time highs. You don't want to invest at all-time highs, but in reality, historically, if you invested at all-time highs in certain markets and just kept your money in there, then you'd be doing well.
Yeah, so there's been studies done where you can invest on the low points of the market, so like your March 2020 crashes, and there's also been studies done where you can invest periodically, dollar cost averaging over a span of time, so buy every month, every 2 months, every 3 months, and it's been shown that both tend to perform relatively the same, and sometimes the dollar cost averaging performs better. So just looking at SPY, of course, it's had a massive bull run. It's very intimidating for people to buy in. But you have to also remember, for example, a stock like Tesla had a massive bull run to 1,000, had a stock split, and then had another massive bull run. So trying to time the market has been historically proven wrong by analysts. The biggest and best economists out there have said that trying to time the market is something that's not productive and will often hurt you. So always the rule of thumb that all great investors will tell you is dollar cost averaging, and then that's the way to protect you. So you'll buy some on the all-time highs. Because we never know when the all-time highs are. You'll buy at the all-time highs, and then when there's lows, you can buy into the lows. And also, one tip again, as we go into the psychology of trading for red days, is on red days buying some stocks or just buying some stocks that you have kind of high conviction in and sort of averaging down helps you kind of stomach the red a little bit better.
Right. Yeah. And I think another thing that helps new traders be able to stomach, like if they do see their portfolio down, especially right now when a lot of newer traders that got into trading after COVID have really only seen the market be going up and up. So it becomes a little testy when you see your portfolio down. One thing that I think newer traders is really just start small. Don't be investing with like all your cash that you have available. You know, if you need to keep some cash on hand to be able to for your living. So I'm not going to put every single dollar that's in my checking account into my portfolio, because on a bad, if something happens, I want to be able to still buy food.
Exactly. So that's another rule of thumb that we're hitting, is only invest money that you're willing to lose. So I don't consider the stock market a casino, but treat it like you're going to a casino, and only invest money that you're willing to lose. Don't invest money like your rent money, your food money. Don't do that. And again, back to the first point of dollar cost averaging in, don't invest all your money at the same time, because you'll have some what they call dry powder, which is the equivalent of having cash on hand for investing for red days when they come about. So it's not as brutal to kind of deal with and digest when those red days hit.
Yes, sir.
All right, so let's take a look at QQQ. Let's review that one. QQQ and SPY have been moving in parallel. This one's doing great. This one, I expect this one to keep running and eventually hitting that all-time high of 139 very, very soon. It's had an all-time high of 138.93. I think we'll get to 139, and we got 50 cents shy of that on Friday. So I think we will hit that and even go to 140 and higher, because tech, as you can see here by the RSI, for folks who are listening, the RSI is at 66.26. So it's not at the oversold territory yet. So QQQ has a lot more room to run and get to another all-time high of, I think we can get between 140 and 145 before we see a small slight pullback. And again, just like SPY, QQQ also has a gap between 133 and 135, I believe. Yeah, a gap between 133 and 144. So it's not that much of a gap. So you can't even really consider that a gap. So there's not much of a gap, but there's a small, tiny little gap there that I imagine we will retrace to during the next correction. So final thing that I want to go over is Bitcoin. Bitcoin for the whole weekend has been kind of consolidating around the 59 to 60K marker. I know a lot of stocks now are trading with Bitcoin. Into the coming week, we're anticipating that Coinbase IPO, which is going to be very, very exciting. And Bitcoin prices, of course, will affect that, because that's a crypto buying and selling platform. It's a crypto exchange. Currently, Bitcoin is just 50 cents shy of 60,000. And I imagine this week we should consolidate around 60,000 and hopefully maybe break and hold 60K. But I'm completely fine with Bitcoin consolidating and holding between 57 and 60K. It's established 55K as a support level now. And now it's going to be fighting to establish 57K as a support level, then 59K, and then we'll eventually break into the 60K area. But one thing, again, dealing with, if you're just a crypto trader that trades Bitcoin or any form of crypto, one thing that I tend to see is a lot of crypto traders and Bitcoin traders specifically always keep asking for all-time highs. It's not, Bitcoin's been on a massive bull run for the past few months. You will not always get an all-time high. It's very rare what's happening now. It's just a massive adoption that's happening with Bitcoin, that a lot of traders and a lot of industries are buying into Bitcoin. So expecting an all-time high every single few weeks is a little bit weird. Everyone's anticipating that 100K psychological number that we want to hit. But personally, I'm sitting back, I'm relaxing, I'm enjoying the show. I'm not letting it bother me. And the best thing you can do is to kind of find stocks that move with this. I do it with my Patreon. I tell them about stocks that move with Bitcoin. They're very simple to find as well. You can find some basic ones, learn them, learn the patterns of those stocks, see the movement of Bitcoin, buy and sell those, and adjust it, and you can kind of do very well. So Aaron, let's jump into our topic. So I'm going to stop screen sharing and we can go full topic into the psychology of dealing with red days. So red days are something that we dealt with for a lot in the past month and the previous month as well. And between February and the final 2 weeks of February and March's first 2 weeks, we had a lot of red. Essentially, it was, I'm just double checking real quick. We had a few weeks of red. We had 1, 2, 3 weeks of red, 1 week of green, and then another week of red. And for the past 3 weeks, it's been green. So one thing that a lot of traders I see is there's a lot of doom and gloom that goes around red days. It's not something to fear. If you're a trader, if you're a scalp trader, this becomes the market for you. If you're a swing trader, your funds will kind of get tied up and kind of level and hold. If you're a long-term trader, this is where the money signs go off in your eyes and you're like, okay, I get to buy my favorite stocks for cheap. And later down the line, I will be able to pillage off of this. We've seen this with many stocks. We saw it with Tesla. which went sub 600 and is now approaching 700 again. So psychologically dealing with red days, one thing that a lot of traders can and should be doing, especially if you're a new trader, is walk away. Just completely walk away from your portfolio, completely walk away from the terminal, from whatever you're trading. Just walk away. If you can't sit there and bear watching the red all day, and you shouldn't really be sitting there and watching the red all day, especially if you're not, only day traders should be the people that are sitting in front of their terminals all day and watching the trades go up and down and trading. If you're a swing trader, you shouldn't be glued to your terminal 24/7, 365 during trading times, because it's not healthy. We get into swing trading. A lot of people get into swing trading to make passive income. You buy a stock, you have a catalyst in mind, you go into the stock with a plan, you expect it to hit that catalyst 1, 2, 3, 4 weeks down the line, and then you cash out. It's meant to be like a small savings account that's accruing you interest based off of a catalyst that'll probably hopefully bring you between 7 to 15 to 30 to maybe even 100% if you were in the 2020 bull market returns. So if you're a swing trader and you got into your plays with high conviction, and we'll definitely have another episode on that where we talk about swing trading and getting into plays with high conviction. If you're going into plays, sure.
Oh, just real quick, so since we might have some newer traders watching, just break down the difference between swing trading versus day trading.
Sure. So day trading is when you buy and sell a stock in the same exact day. So I buy a stock, for example, in the morning at $5 and sell it within the same day for, let's say, $5.50 or $4.50, because you're not always successful on day trades. You can day trade within a minute. You can day trade within an hour. It's just buying and selling in the same day is considered a day trade. But a swing trade is if you buy a stock today and you expect it to appreciate or go up in value, or something to happen like a catalyst or an event or presentation or an earnings, something that's coming down the pike, not the same day, and you expect it to accrue value over time, and that stock will go up. So you buy it today in hopes of it going higher up in value in the future, but a shorter time span versus long-term investing. Most swing trades usually can take between 2 to 3 days to 2 to 3 weeks, sometimes even maybe a month or more, depending on the market conditions. Of course, if you started a swing trade a few weeks ago in the middle of February until now, you're probably still stuck in it. But the key is, if you did your due diligence, if you did your deep dives and you found this as a high conviction stock, you shouldn't be worried about it. Psychologically, in the back of your head, you should keep remembering that, hey, this is a stock that I like. I got into it for a reason. The company has not fundamentally changed. This is just a red day, a red week, a red month, a red year even. We've had red years in the market. I don't even remember. I don't know how long ago, but we've had red years. So if the company has not fundamentally changed, and if the market is just not complying, you bought a stock. A lot of people tend to forget is that a stock is it's kind of a virtual representation of a share within a company. So you're buying into a company. So when I buy, let's say, 10 shares of Tesla, I'm not just buying 10 shares of ticker symbol TSLA. I'm buying 10 segments of this company's outstanding float. So whatever's out there for the stock, I'm saying, hey, I'm buying into the stock. I want to be a shareholder within the stock. And I believe that in a short amount of time or a long amount of time, this stock will hopefully go up based off of my due diligence and analysis. So one strategy is walking away. A second strategy that I tend to kind of do is I always like to have between 20 to 30% dry powder in my account. Dry powder is cash you have on the side ready to deploy for a red day. This is a rule of thumb a lot of investors use. You'll hear Kathy Wood talking about it. You'll hear your best friend on Twitter talking about it, is having dry powder on the side ready to go. So what do I do on these days is I'll wake up, first of all, on the first red day, especially if you're seeing things dropping very quickly. Don't try to catch a falling knife. Catching a falling knife is a term of catching a stock as it's falling. We don't know where the bottom is. Tend to watch to see if you can find the bottom. Sometimes you will hit the bottom multiple times during the day. And it will take some time for that stock to build and find a new support level, which is this new bottom during this red market. And usually it's never just one day of red. One day of red in the middle of a bunch of green shouldn't be bothering you a lot. Really, if it's several red days in a row, that's when things should be starting to kind of affect and start to kind of mentally affect traders psychologically. So when that happens, try to find on the chart the lowest point of that stock. Find your highest conviction stock. So, for example, during the crazy red that was going on during March and February. One of my high conviction stock, which is Palantir, ticker symbol PLTR, went to as low as like $20 a share. So what I did was I said, okay, I like the stock. I know where this company is going in 3 to 6 to 9 months, even longer. I know there's a lot of catalysts coming up for it, like, for example, the infrastructure bill, other stuff. So I deployed some of my dry powder onto that stock. How did that make me feel? A, I lowered my cost average. So again, part of your dollar cost averaging in. B, I felt that I'm taking advantage of this red market and I'm getting a steal. This is the thing. When we go the whole year, everyone celebrates Black Friday. We're like, all right, we're going to get out there. We're going to get that TV for $200. It's $1,000, and we're going to spend the rest of the year enjoying it. And all those other suckers that paid $1,000 just got screwed. This is the psychology that you should be deploying on red days. That, hey, this Palantir stock that was $30 just 2 months ago is now $20. It's on sale. I know the company. I've done due diligence on it previously. This is why you should always be researching companies that you want to buy. That's the work you should be doing. You shouldn't be glued to your terminal watching the stock, kind of the candle is going up and down. Find the stocks that you like for these red days. So I go, all right, Palantir, I like it. Boom, I'm going to grab it, buy it on this red day. And now I'm like, all right, I just took advantage of a really, really good red day. And now I've got something in my back pocket. Everyone else is freaking out. I'm feeling really good. So that's one aspect. Try to do that across the board with your dry powder. But again, don't try to catch a falling knife. Watch the market as it stabilizes. Let's say Palantir comes to 20 and then starts to go into 22 again. That might be a good time for you to start buying it again. This is a purely hypothetical example. Well, we're not financial advisors or psychologists or anything. We're not licensed in anything. This is just pure banter and mentor entertainment purposes only. But again, that's just one aspect you can deploy. And also, a comment that came in so every week we'll be putting out a tweet in relation to the topic, and people can tell us how they deal with red days and how they approach it. One really good comment that came in, shout out to Sean. I can't say your last name, Dr. X. Kafur said, red days are for patience. Do less and plan more. Invest in life. Don't let red days ruin you. So I put out a tweet a few days ago and I said, how much would you pay for a time coin if a time coin would give you one extra day of life? If one red day is ruining your whole day, you need to step away and walk away from that psychologically. We all get into trading in order to attain financial freedom, financial stability, and financial peace of mind. And in order to make our lives better, we want to be able to afford the better car, the better house, the better whatever, the better guitar, whatever you want to be able to afford. You want to be able to put your money deployed there. If you're ruining days, weeks, months, so there was several weeks of red. There was 3 weeks of red. If those 3 weeks of red were miserable for you, it's time to break out of this pattern. Start deploying things. Walk away from it. Take a break from trading. A lot of people were DMing me during this time, and they said, hey, what do I do? I said, okay, you're new. How many positions do you have? They said X, Y, Z. I was like, all right, do you like these positions? Why are you in them? They told me they were high convictions. I said, okay, you shouldn't care about this. If you don't have dry powder, that's completely fine. You're new to trading. Take a step away, take a break, and walk away from this. And they did. They came back, rejuvenated, ready to rock and roll into this new bull market that's forming. So there's nothing wrong with walking away. We are doing this. We're doing trading here, especially for swing traders and long-term investors. It's because we don't want to have a second job. This is not meant to be a second job that stresses us out. Most folks that trade that I deal with on Twitter have 9-to-5s. I have a 9-to-5. Those jobs are where sources of stress can be. Don't let trading be a source of stress and psychological anguish. Producer AB, is there anything specifically you do during red days to cope?
Well, I just can't emphasize enough what you were saying right there at the end. I really relate to that. As far as like specific things to cope with red days, I think we all have our own different ways of dealing with our stresses and stuff. And so mine on red days are the same as for if I'm going through a tough time personally, so I like to, try to get active always helps me. Like you just go to the gym, and even if it's just something as simple as hopping on the stationary bike for like 20-30 minutes, just something to get the blood pumping, always makes me kind of feel a little bit better. And honestly, definitely been overlooking that the past couple weeks, couple months. And, well, let me just address this real quick. Solar Up and Up, is this new? Yeah, this is our first episode of Psychology of Trading. We will be doing this every Sunday night. As Ryan mentioned earlier, we'll be taking some questions from Twitter and also in the comments here about the psychology of trading. And one other thing I wanted to touch on before we get to these questions, because we do have a couple good ones in the comments,
Sure.
is the past few months. I mean, since COVID, when COVID hit and the market crashed and with the big rise of retail investors, part of that was we saw the Russell 2000, which tracks all the small caps, just run crazy. Right. And all these small caps were like outpacing the return of S&P and all these like bigger known stocks. And we've kind of seen that outflow from the small caps and into these bigger names. And what that has done to some people's portfolios is, at least like for me specifically, I've seen like red days on my portfolio where the actual market's green, where like SPY's up 0.5%, NASDAQ's up 0.5%, and then my portfolio's down 5%. And that I think has an even like worse psychological effect, because it just makes me feel like a bad trader. I'm like, wait, the market's green, but my portfolio's red. So I just know other people are probably in that boat. And, you know, I was curious if you had anything to address that, you know, like if your portfolio is red, but the market's green.
Sure. Yeah, definitely. So we talk about this a lot on the show that you and I both do called the After Hours Show on Tuesdays and Thursdays, where we go over the market at 5 p.m. Eastern for an hour and just go through tickers and machine gun it. One mistake a lot of traders make is if you're swing trading, especially small cap or penny stocks, SPY and NASDAQ will not reflect the results you should be seeing. SPY and NASDAQ track that big tech companies, your Teslas, your Apples, your Facebooks. These are what these two indexes track. You should be looking at the Russell 2000 to track where your trades should be going on average. Also, looking at your individual stocks as well will help. But again, the Russell 2000 is the marker that you should be kind of using, the index that you should be using to reflect your trades. And if you look at the Russell 2000, it perfectly reflects what's going on with the small cap market. The small cap market has been struggling. It's been sort of flat for a while now, but eventually I do foresee a lot of money flowing back into the small cap market as SPY makes that all-time high that we discussed in the morning. And we have that in the morning, earlier in the show. It will start to kind of have that small pullback, and money will flow back into the small cap stocks as the market starts to go through. So I see you got Trader Joe's comment up. Psychology is so key to trading. Thanks for posting this important stream. You're welcome, Joe. This is kind of like a love letter, a thank you to the trading community of kind of giving back. I saw so many traders struggling during this, and I hit up producer AB and shout out to him and shout out to Benzinga and Jason Raznick and everyone who just gave so much creative freedom on these shows and this platform to kind of give back to traders. So I said, hey, we have this idea and we're going to hopefully be running with it every single week. So should we get to some questions? I got some really good questions on Twitter that came in that I wanted to address. Trader Belle says, she has a question. She says, how long does it take before you are able to trade with little to no emotion? Okay, so little to no emotion, there will always be a little emotion in your trading, especially if you're a new trader. There will always be a lot of emotion. It comes and it takes time. You will need, it's kind of like a cut. You'll get a cut. Imagine getting a cut in the same place over and over again. Your scar tissue will build stronger and stronger every single time. They say sometimes if you break a bone, it gets stronger when it kind of heals. Again, really weird examples. I couldn't think of anything else. I forgot the word galvanized, and it just came to me. It's kind of like galvanizing metal. If you galvanize metal, it gets stronger. If you galvanize a ship, it gets stronger. So it's kind of like galvanizing. Going through these red markets, it will get stronger and stronger and stronger. Your psychology will get stronger and stronger, and then you'll be able to come out of it over time. There will usually never be a time when you have zero emotions. Any trader tells you zero emotions, you got to be a robot or an algorithm. But of course, it will take some time for you to get to zero emotions or close to no emotions. And again, having no emotions is a good thing. Cutting emotions out is a good thing, but there will always be some form of emotion built into it. Producer AB, any thoughts on that question?
Yeah, I mean, like you said, I think the more you trade, the less, you know, like anything else, like the more you do it, the better you'll become at it, the more you'll be able to understand how to handle your emotions while doing it. So I've seen some funny comments. Sorry, Mark Aguilar said I turned my phone upside down and smile.
That's another thing you can do is, for example, if you're using Webull, you can turn the red candles into yellow candles, which is red is more of a psychological warning color in your head, but yellow is less gruesome on the eyes and the mental state. So you can kind of do that transition within the custom settings of the phone. I think Robinhood also has that. TD should also have that as well. So just small little tricks you can do. Again, walk away, or turn your phone upside down, like Mark said, and just imagine the green is red. Also, Weeble has this funny thing where you can kind of switch the red and the green. So on red days, the green will be red and the red will be green. So again, I don't know who you're fooling there, but you can always do that as well.
Yeah. And then I wanted to address this comment as well from Greg. He says trading is psychology. The charts are just real-time readout of the mindset of all traders.
That's true.
There's some truth. Yeah, there's a lot of truth to that. Like when a stock starts dropping, it'll only get to a certain point before people realize, oh, this company is now being undervalued, and then it swings back around. And it's all about mindset of the traders. It's like on the way down, people start selling it, and then once it starts curling back up again, people start buying it. Yeah. And for retail traders, at least, retail traders tend to kind of act in the same. I'm not going to say hive mind, but they're acting in the same realm, and then that's where some more experienced traders come in and are able to make a lot of money, because retail traders will all be selling one thing and they realize, why is everyone selling this? And then they buy it, and then it ends up working out for them.
Yeah, I saw a question come in about wash sale. So wash sale is when you buy and sell a stock. If you buy and sell a stock for a loss and then you buy the stock back within 90 days, you won't be able to write those losses off when you're doing your taxes. So that's a wash sale. But again, like you said, it's the whole hive mind is a great word to use for it. You'll see this on the different aspects of trading, depending on the level the trader is and how mature they are into trading. You'll see, like, on when they get to a certain point on the second of third week of red, you'll see them start selling off. And to me, at that point, that's heartbreaking, because you've already seen your stock come down so much. This is money you've worked hard for. Hopefully you followed the rule where you only invested what you can afford to lose. But it's never good to lose, because at the end of the day, like you said, fundamentally, these companies haven't changed. We saw Facebook come down hard. We saw Apple come down hard. We saw Tesla come down hard. But nothing fundamentally changed about these companies. Just last week, we saw Tesla came back and they blew out their delivery numbers for Q1, and they did fantastic. So you have to just keep that in mind in your head psychologically. Is this a company I did enough due diligence on? If yes, has anything changed fundamentally about the company? If the answer is no, well, if you got dry powder, buy more. Or sit on the sidelines and watch it come back up, or do something else. Go out and watch a movie, have some fun, catch up on a TV show you haven't seen. Enjoy life. Remember to enjoy life. That's very, very, very important. One comment that I got from Gary Kissel said, adding to long-term conviction stocks, again, like we've been discussing, and reducing exposure to speculative swing trade equities. So again, if you're in a speculative trade just based off, for example, technical analysis on a reversal, and you see the stock dropping, that's when something like a stop loss, which is a tool that you can kind of build into a trade. You put a stop loss, and hey, if my trade comes to X amount of dollars, cut the position. That's when your stop loss comes in for your speculative swing trades. But for your long-term swing trades, your high conviction trades, again, you can deploy a stop loss to protect you during red markets, but you also have to remember, we never know how long or how short a red market can be. You can have one red day that can trigger your stop loss, and then the stock is a bull run. You can have one massive month of blood red where your position gets completely obliterated. So that means you need to psychologically also set up a stop loss in your head for a position. And that goes back to doing your due diligence and going into a stock with a plan. So again, going with there. And Rumor says paper trading helps. That's also another thing you can do. If you can't trade this market, if you can't trade red markets, and you want to start learning how to day trade or scalp trade, paper trading is a perfect opportunity and tool to use during these markets. Okay, let me figure out how these day traders and these big money makers are making these gains. Go in there, learn how to paper trade real quickly. So when the next red market comes out, you can do one or two kind of day trades or swing trades or scalp trades to kind of offset your losses. And of course, one other thing you can do, we'll do a whole episode on these, is hedging your account with bear ETFs and bear stocks, but we'll do a whole different episode on those to discuss those.
I love it. Let's take one or two more questions from the chat, and then we'll wrap up.
Sure, producer AB, you want to pick them?
Yeah, so I know you had picked them from Twitter, so I'll pick the ones from YouTube.
And folks, smash the like button if you're watching the YouTube stream. Let's get those likes up. If you're listening to the audio podcast.
Do you have any good book recommendations?
Okay, so book recommendations on the subject or resources for traders. So personally, I'm not someone who reads too many books, so I cannot help you when it comes to books. But resource for traders is there's a lot of YouTube channels out there. I'm not going to point to any specific ones, but again, a specific channel they can come and watch, for example, is Benzinga. Benzinga always has daily streams during the week where you can come to and watch and see where the market's going. And these guys that are on the show are regular retail traders like us. They're people who know the markets. They've established they know the market. Benzinga brings them on and they talk about the market, and especially shows like Power Hour, Technical Trading in the Morning, SPAC Attack. These things, they'll kind of give you a rundown, and you'll be able to find some sort of confirmation bias that you're not going crazy. Your stocks don't suck. The companies haven't gone to hell. It's just the overall market. You can also watch other shows and other networks and other stuff like that. But books wise, I don't really know how to help you there in terms of books or resources. But again, look for sources to tell you and learn to see where the market's going. And again, Benzinga, I'm not just trying to plug the network because we're here. You can do that and go there. Also, during red markets, I tend to put out a daily update when things are going wild to kind of give you guys on my Twitter, updating you on, hey, this is where the market is going. We've seen it with Bitcoin. We've seen you can easily see a correction versus a crash. And also cut out the negative resources. You might be following a bunch of people who love to go around and say, hey, the market is crashing every single day. Cut those people out of your life because they're only psychologically hurting you and psychologically building a devastating wall in your head of fear. And fear mongering is a tactic that you have a lot of short sellers use and people who use puts used in order to be able to move the mind, especially these bigger traders who tend to do it or have big followings on YouTube, Twitter, Reddit. You'll see it there. So cut these resources out, especially if you're not a bear trader and you're a bull trader.
100%. And I saw after we brought that up, 2 people in the comments from Zinger Nation said Trading in the Zone by Mark Douglas is essential in the learning of psychology of trading.
There you go.
I haven't read that book, but I've got it pulled up and I'm going to order it. I'm going to throw the Amazon link in here too.
Perfect.
We've got another recommendation, Mark Minervini. Mm-hmm. So yeah, I mean, it looks like there's a lot of good books about the psychology of trading, and maybe we'll have to do an episode where we do like a book report on one, a book club. We'll both read a book. We'll both read the same book for 2 weeks, and then we'll do a episode where we break down that book.
Definitely. I think so. Yeah. Do we have time for one final question from these folks?
One final question. Yeah, of course.
I saw a good question earlier come in.
I know it's hard to go back and find. I had some good ones. And then
yeah.
Mark said, "Can you talk about FOMO and buying at the top?" Should we end on that?
Sure. Perfect. That's actually a good one. We'll go with the opposite of a red day, FOMO, because one thing that you'll see traders having is as the red goes back to green, you'll see people start to FOMO. One thing to also realize is, if you look at SPY, there was 3 weeks of red, 1 week of green, then another week of red came down. So you won't always escape the green. You won't always escape the red into green, to a green highway where things go. You'll usually see small pullbacks and corrections on the way to the bull market that's upcoming. So again, how to avoid FOMO and buying on the top? Dollar cost average in. You're never fully buying at the top. As long as you're dollar cost averaging in, sure, you bought at the top, but this isn't the top of a long-term investment or a long-term thing. In 10 years, you will have bought at the bottom. So imagine you see a bunch of articles, and a lot of people hate on these articles. Had I bought 10,000 shares of Tesla back in 2010, how much money I would have made now? The point of those articles isn't to show you that, hey, go back in time, you idiot, and you can get this money. The point of these articles to show you is that these stocks have room for growth. Most stocks that are long-term tech stocks, value stocks, growth stocks will grow over time. If the company's good and it's not a crappy company, they will grow over time. And as long as you dollar cost average in, you'll be able to attain these gains and make money off of your plays long term. So dollar cost average in, you'll never be buying at the top, and you won't have to ever worry about having your average be all the way at the top.
Beautiful. I think that was a perfect way to wrap up the show.
All right. Thank you all so much for watching the very first episode of Psychology of Trading. Thank you so much, Producer Aaron. Producer Aaron, where can they find you on Twitter? Do you want them to find you on Twitter?
Of course. I want everyone to find me on Twitter. I want to have 1 million followers by the end of the year.
Let's get this guy to 1 million followers. What are we doing, guys? Get this guy to 1 million followers.
I'm posting the link in the comments. I'll post yours too, Ryan, and then we'll both get those followers count up.
Let's get those followers.
You can find me. Follow back.
Yeah, Aaron follows back, so you guys can follow us. I try to do as many daily updates as I can. If people have any questions around this topic, I'll be more than happy to answer them. Just tweet them at me. The link to my Twitter is there. I'll be more than happy to answer them. Again, the goal of this this show is to keep it short, small, and sweet, and you'll be able to come back and watch it on the Benzinga Network here, and hopefully we'll have it up on Spotify and Apple very, very soon. So thank you all so much for watching. Thank you, producer AB, and thank you, the Benzinga Network.
Of course, and thank y'all for watching. We'll see you next week.
Good night.